Welcome to this explainer. Let's just jump right into it, shall we? Today, I'll be putting on my financial advisor hat because, let's face it, current market volatility is keeping everyone on edge right now. We're going to break down the exact systemic mechanics of why the US dollar is weakening, why gold is surging in response, and why Bitcoin is just waiting in the wings for its moment. If you've been wondering how all these massive macroeconomic puzzle pieces fit together to impact your portfolio, well, you're absolutely in the right place.
Right off the bat, there's an undeniable reality flashing across market tickers. The US dollar is weakening. And the upcoming moves from the Federal Reserve regarding this, they could literally change everything. We aren't just talking about some abstract economic theory here. We're talking about real-world shifts that directly impact the portfolios of millions of retail investors around the globe. When the foundational currency of global trade starts to slip, you better believe the aftershocks are felt in every single asset class. And we're seeing an immediate, almost mirrored market reaction right now. As the US dollar index loses its grip and flattens out, there is a rapid rise in the price of gold, pushing past massive resistance levels and testing historic highs above $2,400 an ounce. It's a classic flight to safety, for sure, but it's being driven by very specific modern market dynamics. So what happens next? Here's our quick roadmap. We'll cover the dollar's global impact, exactly why gold is rising, the Federal Reserve's role, Bitcoin's liquidity backdrop, and finally, what you should actively watch to protect your wealth. Section 1. The dollar's global impact. Look, while most everyday retail investors don't wake up and immediately check the dollar index, they absolutely need to understand its gravity. To really grasp its weakness, you have to look at inflation. Think of inflation like a slow leak in a tire. Day by day, it just quietly diminishes your purchasing power. With recent inflation data stubbornly hovering around that 3 to 3.5% mark, that tire is visibly losing pressure, and it's forcing global markets to pay immediate attention. Because when the dollar weakens, it dictates the trajectory of, well, pretty much everything else. The dollar's strength directly influences the pricing of global commodities, the real return on your personal investments, the flow of international trade, and specifically the price action of gold. It's essentially the sun that these other financial planets orbit around. When its gravitational pull shifts, the entire solar system feels it. Section 2. Why gold is rising. As reported by Reuters, a weaker dollar has made gold fundamentally more attractive to foreign buyers, while markets wait for Federal Reserve signals. This isn't just everyday retail enthusiasm we're seeing. This is massive, calculated international capital rotating directly into the precious metal. Simply put, when the dollar drops, the rest of the world goes shopping for gold. It's actually a really simple, powerful mathematical relationship. Because gold is globally priced in US dollars, a weaker dollar makes it fundamentally cheaper for international buyers using foreign currencies. That instant discount creates an aggressive spike in global demand. And, as we all know, when demand spikes against a relatively fixed supply, prices are going to rise rapidly. But hey, it's not just the exchange rate. Investors are actively using gold as a historical hedge against three massive pillars of risk: persistent inflation, fluctuating interest rates holding near a 23-year high of 5.25 to 5.50%, and simmering global uncertainty. These three pillars are actively keeping gold squarely in the focus of smart money. Section 3. The Federal Reserve's role. Ultimately, everything in this cycle comes right back to the root cause: central bank policy trends. If the Fed stays aggressive and keeps interest rates higher for longer to fight off that stubborn inflation, the dollar traditionally strengthens, which puts heavy downward pressure on gold prices. But if the Fed pivots and signals lower rates, the dollar weakens further, heavily supporting and potentially accelerating gold's upward trajectory. Which brings us to the concept of global liquidity. As an advisor, the easiest way I can explain this is to think of the Fed's rate policy as a massive liquidity faucet. When they decide to lower rates, they're essentially twisting that faucet open. Cheap money floods the financial system, and that rising tide of liquidity lifts asset prices across the board. And that liquidity faucet is literally the #1 reason why retail and institutional investors right now are agonizingly analyzing every single word from Federal Reserve officials. Just one sentence hinting at a definitive rate cut can open that faucet and send global markets flying. Section 4. Bitcoin and global liquidity. Now, this liquidity dynamic perfectly transitions us into Bitcoin. While gold is your classic safe haven, Bitcoin is often treated by the broader market as a risk asset. And historically, a weaker dollar environment, coupled with that open liquidity faucet we just talked about, serves as a highly positive backdrop to support risk assets, including crypto. When dollars are cheap and abundant, global capital aggressively hunts for high-yield, high-growth alternatives. However, you have to understand that Bitcoin doesn't always move in exact lockstep with gold. It's a slightly more complex beast. Right now, it's reacting to a rapid mix of deep institutional adoption, massive ETF demand soaking up available supply, shifting retail market sentiment, and, of course, broader global liquidity. But despite those complex variables, there is zero doubt among serious investors that a weakening dollar acts as a critical, foundational catalyst for crypto markets. If the dollar falls, it removes a massive macroeconomic headwind for Bitcoin. Section 5, what investors should watch. So, as a retail investor trying to navigate this cause and effect macro arc, what do? You need to meticulously watch three things. Step 1, monitor the Federal Reserve's policy signals. Step 2, track upcoming inflation data, because inflation completely dictates what the Fed will do. And Step 3, watch the real-time direction of the US dollar index. These are your ultimate leading indicators. Make no mistake, these three forces will completely dictate the board in the coming months. We are undeniably entering a critical period for global finance. The next major directional market move, it could happen much sooner than many complacent investors expect. So, as we enter this highly volatile but opportunity-rich period, ask yourself how your portfolio is actually positioned right now. Based on everything we've covered, will gold continue its historic rise? And can Bitcoin fully capitalize on this weaker dollar to break out to new highs? The data is on the table. Central banks are making their moves, and now it's up to you to stay focused. What's your next move going to be?